Airbnb's impressive revenue growth and global expansion signal a potential gold mine for value investors. But with accumulated losses, rising liabilities, and a surprising 69% drop in net income, is there more beneath the surface? Join us as we dive deep into Airbnb's financials to uncover whether it's a hidden gem or a looming risk. Ready? Let's roll! Airbnb Inc., founded in 2007 and based in San Francisco, has transformed the hospitality sector through its global online platform. By enabling hosts to monetize their homes, be it private rooms or entire properties, it capitalizes on the sharing economy, where underutilized assets are shared for profit. This model disrupts traditional lodging services, highlighting the importance of peer-to-peer marketplaces in assessing Airbnb's competitive edge and growth prospects. Airbnb's balance sheet reflects strong liquidity, with $7.7 billion in cash, an equivalent as of September 30th, 2024. This solid cash reserve supports the company's growth initiatives in product development and customer relations, despite high operational expenses. The debt level is modest, featuring $2.0 billion in convertible senior notes due in 2026, and no borrowings from the $1.0 billion credit facility, resulting in a favorable debt-to-equity ratio of 0.3. A lower ratio like this indicates reduced financial risk. The share repurchase program, with $1.1 billion of the $6.0 billion authorization already utilized, signals management's confidence in the company's valuation and a commitment to enhancing shareholder value. However, negative retained earnings of $3.8 billion suggest accumulated losses, which could impact the company's equity and should be monitored closely. Here's a screenshot of the full balance sheet. Notable is the increase in total liabilities to $13.1 billion, primarily driven by accrued expenses, suggesting a need for cautious cash flow management. This liability trend could increase financial risk if not offset by growth in assets or revenue. Airbnb's balance sheet is robust, with high scores in cash minus debt and debt to equity, surpassing most industry and index peers, indicating strong liquidity and low leverage. Yet its lower retained earnings to market cap ratio suggests less profit retention relative to market value than competitors. Airbnb's revenue grew 10% year over year to $3.73 billion, boosted by increased customer engagement. Yet net income fell 69% due to a $3.1 billion income tax expense from last year's valuation allowance change. The gross margin of 87.5% shows strong operational efficiency. An operating margin at 40.9% indicates effective expense control. Investments in customer relations, product development, and marketing may fuel future growth. Management is positive about international expansion. Despite healthy margins, the sharp net income drop is significant. Investors should assess if rising costs will lead to sustainable profits. Here's a screenshot of the full income statement. Notably, Airbnb's cost of revenue remains stable, reflecting effective cost management. However, increased spending in product development could impact short-term profitability, but might drive long-term growth, a typical value investor concern. Airbnb shows impressive profitability, outperforming over 90% of industry and index in net and operating income margins. EPS growth is strong. SG&A margin is moderate, better than peers, but below S&P 500 averages. Airbnb's recent financials show a strong upward trend. Revenue in the latest quarter jumped to $3.73 billion from $2.75 billion, highlighting significant growth. Net income soared to $1.37 billion, a remarkable turnaround from the prior year's loss. This suggests effective cost management despite higher operational expenses and taxes. The company's focus on international expansion and boosting customer engagement is paying off, especially in nights and experiences booked, a key metric indicating user activity on the platform. Such robust performance signals potential value for investors, though monitoring expenses and competition remains important. Looking at Airbnb's cash flow statement, we see operating cash flow decreased to $1.1 billion in Q2 2024 from $1.3 billion, indicating seasonal booking patterns and operational challenges. This decline in free cash flow might raise concerns for value investors who prioritize consistent cash generation. However, management notes that the downturn is partly seasonal and stresses that their strategic investments, especially in international expansion, aim to bolster future cash flows. It's crucial to assess whether these investments will translate into improved financial performance in the coming quarters. Here's a screenshot of the full cash flow statement. Particularly concerning is the net cash used in financing activities, which shows a cash outflow of $2.2 billion in 2024. This level of outflow can indicate financial strain or strategic buybacks impacting liquidity. Airbnb delivered a strong Q3 with revenue rising 10% to $3.7 billion and net income hitting $1.4 billion, yielding a healthy 37% net margin. This indicates efficient operations and solid profitability. The launch of the co-host network aims to make hosting more accessible, which could drive future growth. However, regulatory challenges in cities like New York present risks that could impact listings and revenue. Expansion into underpenetrated markets like Japan and Brazil shows promise, potentially unlocking new revenue streams. While margins may tighten in Q4 due to investment in growth initiatives, these strategic moves could enhance long-term value for investors. Analysts project Airbnb's net income to reach nearly $5 billion by 2028, indicating strong profitability from international expansion. The expected gradual increase in earnings per share reflects solid corporate performance. For value investors, these growth prospects suggest potential long-term gains. It's important to compare these forecasts with competitors and consider market risks to determine if Airbnb meets investment criteria. Airbnb's net income and EPS scores are average in its industry at 50 and 45, yet they stand out into the S&P 500 scoring 90 and 88.6, highlighting strong profitability versus the broader market, but room for growth among peers. Looking at key valuation metrics, Airbnb's PE ratio of 18.1 is notably lower than peers like Norwegian Cruise Line at 51.18 and TripAdvisor at a staggering 300.16. The PE ratio indicates how much investors pay for each dollar of earnings. A lower PE suggests the stock may be undervalued. This implies Airbnb offers better value relative to competitors. Coupled with strong free cash flow and strategic expansion into Asia and Latin America, Airbnb appears well positioned for long-term growth, potentially presenting an attractive opportunity for value investors. Our Bow score indicates Airbnb's PE ratio outperforms 77% of its industry peers and 69% of the S&P 500, highlighting strong earnings value. However, its PB ratio only surpasses 41% of the industry and 21% of the index, suggesting potential overvaluation relative to its book value. Using discounted cash flow analysis, which estimates a company's value based on its future cash flows, we project Airbnb's intrinsic share value to reach $134.30 by 2028. This aligns with management's aggressive growth targets and global expansion. The current market price of $129.63 indicates potential for appreciation under positive growth scenarios. Our DCF model incorporates conservative assumptions, factoring in macroeconomic conditions. Strong expected free cash flow underpins this outlook. For investors, this suggests Airbnb may offer value, but risks like economic shifts and competition should be considered. Airbnb's industry DCF score of 85 highlights superior projected cash flows and strong valuation among peers. However, its 65.6 score relative to the S&P 500 suggests that while outperforming most of the market, its valuation could be more competitive. Airbnb's stable closing price at $129.63 shows steadiness, but analysts forecast volatility from $50 to $170, indicating large price swings. This reflects economic pressures and uncertainty in travel recovery, stressing the importance of investor confidence in Airbnb's long-term growth. Airbnb's analyst forecast score is considerably lower than most of its industry peers, and the S&P 500 suggesting analysts anticipate it may underperform. This could reflect concerns about competitive pressures or challenges in sustaining growth, impacting expectations for the company's future performance. Airbnb showcases a strong liquidity position and robust growth, with a 10% revenue increase and impressive gross and operating margins. Its low PE ratio compared to industry peers points to potential undervaluation. However, accumulated losses reflected in negative retained earnings and rising liabilities due to accrued expenses raise concerns about financial stability. The significant drop in net income, influenced by substantial tax expenses, and decreased operating cash flow, highlight potential risks. For value investors, while Airbnb's strategic expansions offer promise, It's crucial to critically assess whether this growth can translate into sustainable, long-term profitability amidst these financial challenges. Make sure to watch another video from our Value Explorer series by clicking the playlist below.